Consumer lending refers to the various forms of consumer debt, including personal loans, student loans, credit card receivables, auto loans, and many other forms of consumer credit. Today, there's over $17 trillion of household debt in the United States as part of the overall consumer lending complex. And this is an integral part to the specialty finance opportunity set that we see today. We'll hone in on two main sub-asset classes, personal loans and credit card receivables. We see opportunity here because of two key themes. First, the resilience of the U.S. consumer and why that is. And second, the funding gaps left by the banks in the overall marketplace. Household balance sheets have significantly delevered since the global financial crisis. Household loans historically represented a greater share of GDP relative to corporate loans. However, this trend reversed in the fourth quarter of 2017. Household debt servicing costs have remained low by historical standards, in large part because of the existing stock of American mortgages, which today is a 95% fixed-rate mortgage. Over the last several years, we have seen banks pull back from lending to the consumer. This has led to increased partnership opportunities for us to work with banks. The Basel III Endgame continues to be a factor for banks, and therefore we expect the consumer complex to remain an attractive investment area for our clients going forward.
Over the last year, we have had many questions on the state of the US consumer, and rightfully so. While household balance sheets are strong, with networks at near record highs due to rising home prices and stock market values, recent reports of higher delinquencies have raised concerns about the US consumer's health, but not all consumers have the same credit profile. PIMCO has extensive experience investing in the consumer loan market. We have built a large, granular US consumer credit database that stretches back to 2005 and has an estimated 35 to 40 billion data points. This data set allows us to do a few different things. First, it allows us to gain real-time insights on the consumer health. Second, the data set allows us to build through the cycle asset-specific credit models, which form the foundation of our underwriting activity. To invest in these loans, we have also built great relationships with consumer loan originators, with banks and credit unions, and financial technology companies. While banks have scaled their presence in the consumer lending market, PIMCO has provided and expects to continue to provide liquidity to originators through the market cycle. This allows us to influence pricing and structure what we believe are favorable terms for our investors. I want to talk about two areas of consumer lending market where we see great potential opportunities. The first is the personal consumer loan market, which we have been investing since 2017. We have deployed over $5 billion, and we have developed a number of significant relationships in the space. In the personal loan space, the combination of bank retrenchment coupled with tighter origination standards has created new opportunities to move higher in quality while achieving compelling spreads. This dynamic has allowed us to invest in loans at attractive spreads relative to historical levels and incorporate more structural downside protection. The other area we see potentially compelling opportunities is in the credit card space. Oftentimes, banks will work with co-brand partners that want to issue credit cards to a broad credit spectrum of borrowers. However, the bank wants to retain what's in their sweet spot. So PIMCO can invest in the receivables that the bank does not want to keep, giving investors exposure to asset pool that we may not have otherwise been able to access. It allows PIMCO and the bank and the potential merchant partner to achieve their goals and isolate the segment of borrowers that we want exposure to.